Compound interest is a powerful tool that can significantly grow your wealth over time. It's the process of earning interest not only on your initial investment, but also on the accumulated interest from previous periods. This creates a snowball effect, where your money grows faster the longer you leave it invested. In understanding compound interest, the key to growing wealth, we'll break down how compounding works, why starting early is crucial, and strategies to maximize its benefits. Whether you're saving for retirement, investing, or managing debt, understanding this concept can transform your financial future. Today, we will talk about understanding compound interest, the key to growing wealth. So before we start, make sure to hit the like button and subscribe to my channel. What is compound interest? At its core, compound interest is the interest calculated on both the initial principal and the accumulated interest from previous periods. In simpler terms, it's the interest on interest. Unlike simple interest, which is calculated only on the principal amount, compound interest allows your investment to grow at an accelerating rate because the interest you earn is continually added to your principal. This means your money starts working for you, generating more returns over time. The mechanics of compound interest. The formula reveals that the frequency of compounding plays a crucial role in how fast your money grows. The more frequently interest is compounded, annually, semi-annually, quarterly, monthly, or even daily, the greater the accumulation of wealth. For example, daily compounding will yield more interest than annual compounding, even if the interest rate remains the same. The power of time and compounding. One of the most critical elements in harnessing the power of compound interest is time. The longer your money has to compound, the more significant your returns will be. This is why starting to invest or save early is so essential. Even small contributions can grow into substantial amounts if given enough time. To illustrate this, consider two investors, one who starts investing $5,000 per year at age 25 and stops at age 35, and another who starts at age 35 and invests $5,000 per year until age 65. Even though the first investor contributed for only 10 years, they often end up with more money by age 65 because their investments had a longer time to compound. The rule of 72. A simple way to estimate how long it will take for your investment to double with compound interest is to use the rule of 72. This rule states that you can divide 72 by the annual interest rate to get an approximate number of years it will take to double your investment. For example, if your investment earns a 6% annual return, it would take about 12 years for your money to double. 72/6 equals 12. The rule of 72 is a handy tool for understanding the impact of different interest rates and the importance of seeking higher returns when possible. How compound interest affects loans. While compound interest is an excellent tool for growing wealth, it can also work against you when it comes to debt. Loans like credit cards, payday loans, and some personal loans use compound interest to increase what you owe. If you only make the minimum payments, the interest compounds over time, making it much harder to pay off the debt. This is why understanding the terms of any loan is crucial, and why paying off high-interest debt as quickly as possible can save you significant amounts of money. Practical applications of compound interest. Savings accounts and certificates of deposit, CDs. Many banks offer compound interest on savings accounts, making them a safe but relatively low-return way to grow your money. CDs often provide higher interest rates than traditional savings accounts, with interest compounding over time. Retirement accounts. Accounts like 401(k)s, IRAs, and Roth IRAs are excellent vehicles for taking advantage of compound interest. These accounts not only offer tax advantages, but also allow your investments to grow significantly over time. By regularly contributing to these accounts and reinvesting your dividends, you can build a substantial retirement fund. Investing in the stock market. The stock market has historically provided higher returns than savings accounts or bonds. By investing in a diversified portfolio of stocks, your money can grow exponentially through compounding. Reinvesting dividends from stocks and mutual funds further accelerates this growth. Bonds and treasury securities. Bonds are a safer investment option than stocks, but they also benefit from compounding interest, especially if you reinvest the interest payments. Treasury securities, such as treasury bills and notes, are considered very safe investments and also take advantage of compound interest over time. Compound interest and inflation. While compound interest helps grow your wealth, it's also essential to consider inflation, which erodes the purchasing power of your money over time. An investment that earns 3% interest annually may not keep up with an inflation rate of 2%, leaving you with only a 1% real return. This is why seeking investments with returns that outpace inflation is crucial for long-term wealth building. Assets like stocks, real estate, and inflation-protected securities can help counteract the effects of inflation. Understanding the differences between annual and more frequent compounding. Interest can be compounded annually, semi-annually, quarterly, monthly, or even daily. The more frequently interest is compounded, the greater the accumulated interest will be. For example, if you invest $10,000 at an annual interest rate of 5%, compounded annually, you would have $10,500 at the end of 1 year. However, if the interest were compounded quarterly, you would have $10,512.68. Although the difference may seem small, over many years, it becomes substantial. Real-world examples of compound interest. Consider the case of a 25-year-old who invests $10,000 in a retirement account with an average annual return of 8%, compounded annually. By age 65, without any additional contributions, that initial investment would grow to approximately $217,000. If the same individual waited until age 35 to invest the same $10,000, it would only grow to around $100,000 by age 65. This example underscores the massive impact that time has on the growth of investments through compound interest. Compound interest and wealth building. The ability to grow wealth through compound interest is a key reason why many wealthy individuals emphasize the importance of investing. The wealthiest people often use compounding to their advantage by investing in stocks, real estate, or business ventures that provide high returns. Even if you're not aiming to become ultra-wealthy, compound interest can still help you achieve financial security and reach your goals, such as buying a home, funding your children's education, or enjoying a comfortable retirement. Overcoming psychological barriers to investing. One of the biggest obstacles people face is the fear of investing. Many are afraid of losing money or don't believe they have enough to start. However, understanding how compound interest works can help overcome these fears. The earlier and more consistently you invest, the less you'll need to save each month to reach your financial goals. It's also essential to stay focused on the long-term benefits rather than short-term market fluctuations. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.